This is the performance summary for week 21 of 2025, which was the week ending May 23rd. So this past week, there were no trades generated. The strategy found no trading opportunities, so it was flat. So I thought I'd take this time to just maybe look at one of the robustness tests I use in designing strategies. So that test involves just taking the same rule set and applying it across different indexes. So the strategy as is, it trades the S&P 100 index or the OEX index, which consists of the largest 100 stocks in the United States by market cap. So these are mega cap stocks. So what I do as an out of sample test, well, sort of an out of sample, is apply the same strategy to the S&P 500, and then I apply it to the Russell 3000. And the Russell 3000 is defined as cap-weighted stock index that seeks to be a benchmark for the entire U.S. stock market. And it uses the 3,000 largest publicly traded companies by market cap. So this is what the comparison looks like. So here's the one that we're trading, the S&P 100, and the annualized return is around 20%, whereas the S&P is 8.37 over this time frame from 1994 to present day. And this is what the equity curve looks like of what we're trading. And next is the one is applying the system on the S&P 500. And there, the rate of return is 16% for the strategy. And this is what the equity curve looks like if we traded the S&P 500 stocks. And it should be noted that these back tests are free of survivorship bias. It's looking at the actual index constituents going all the way back in history. And so this is what it looks like. And then this is the Russell 3000. So if we apply the same strategy to the Russell 3000 stocks, you've got a 14% annualized return. And this is what the equity curve looks like. So you can see there's a bit of a degradation in performance as you get bigger and bigger in the indexes. And the reason for that is, and practitioner research over the years has shown this, the mean reversion anomaly that we're picking up on in the strategy tends to be prevalent in larger cap stocks. And the reasons for that are numerous. For example, mutual fund companies, large institutions, hedge funds, they're all bound by liquidity constraints. So they're going to be trafficking in the largest of large cap stocks. And that's basically the S&P 100 stocks. They have needs for rebalancing their portfolios or, meeting VWAP considerations for execution and so on and so forth. And that's all most easily done in extremely large cap stocks. So the mean reversion logically is more prevalent in mega caps. So anyway, that's just a quick analysis I wanted to show you this week in the absence of a performance summary. So that's the review for week 21 of 2025. If you want to learn more about the strategy, please visit my website at returnstream.com. Link is below. Thank you.